Chapter 7 is on activity-based costing, and this is a tool that is used to aid in decision-making, not necessarily a standalone costing system. It's designed to provide managers with cost information for strategic planning and decision-making. They look at capacity, and which means that they'll have to use the variable costs as well. And this is not a replacement for a costing system such as job order costing. This is used in addition to internally to help make management decisions. So the first thing we're going to do is to look at ABC costing and how it differs from the traditional costing system. First off, in ABC, non-manufacturing as well as manufacturing costs can be assigned to products. With normal traditional product costing systems, we separate period costs and product costs. But with ABC, they don't separate by product and period. They separate by what cost is being driven by that activity. Here's a chart that shows the process of this. First, here with the traditional product costing, you have all manufacturing costs going in. With ABC product costing, you have most but not all manufacturing costs and some non-manufacturing costs. Another thing to take a look at when looking at ABC is the level of complexity. The process that you go through in the calculations for ABC is very complex compared to using an overhead rate such as a plant-wide or a departmental rate. Also, because ABC is activity-based, it tends to have a larger number of cost pools because you have more activities going on in a company. A cost pool has its own unique measure of activity, while traditional costing systems usually rely on direct labor hours or machine hours, and that is used as the allocation base. But with ABC, you look at the unique measure of activity. How many did they make? How many did they use? How long did they use it? So an activity is just an event that causes the consumption of overhead resources. This activity could be anything, and you'll see in the next slide what type of activities you can use. So it works like a cost bucket, which costs related to that single activity measure are accumulated. There are two common types of activity measures. The first one is a transaction driver. This is just a simple count of the number of times an activity occurs. Or you can have a duration driver, which measures the amount of time needed for an activity. So you're looking at either the number of times or the amount of time needed. Traditional cost systems rely exclusively on allocation base, and it's driven by the volume of production. ABC defines 5 levels of activity that don't relate to the volume of units produced. It could be based on unit level, batch level, product level, organization sustaining, or customer level. Okay, we're going to take a look at this company, Baxter Battery Company, and this is their income statement. They make 2 types of batteries, Sure Start, which is the standard battery, and then Long Life, which is a deluxe battery. And this is the first time that the company has ever reported a net loss. They have a $2 million net loss for 2017. And we're going to take a look at these costs and change them and move them around into ABC costing so we can better manage the two types of batteries. Okay, here are the cost pools that we're going to use for ABC. We have customer orders, and that is going to be based on the number of customer orders. Design changes, and that's the number of design changes. One reason why we're looking at customer orders is because if customers place an order very often and they're only ordering a couple at a time, a couple batteries at a time, that's not cost effective for our company. It takes the same amount of time to place an order of 2 batteries as it does for 7 batteries. So the more often orders are happening, the more expensive the cost is. So we want to take a look at the customer orders and see if maybe we need to decide on having a minimum number of orders. Then design changes, which is the number of design changes. The Sure Life battery, or what was it, Sure Start battery, does not have any design changes, but the other battery does. And then also the order size. The order size is based on machine hours because they have to produce the battery. Then we have customer relations, which is the number of active customers we have. Okay, customer orders. It's assigned all costs of resources that are consumed by taking and processing customer orders. This includes the salaries of the people working in the customer service department. It also has the managers and the cost of ordering and the invoices, anything that has to do with taking and processing a customer order. Design changes, all of those costs are consumed by the customer who's requesting the change. And then the order size is based on the number of units produced. Customer relations is the cost associated with maintaining relations with customers, which includes time the employees take to maintain that customer relationship. And then we have our other expenses. Okay, we're going to first look at assigning costs in the first stage of allocation. Okay, now this is all of their overhead costs for both batteries. It's separated out by production department, general administrative department, and the marketing department. The total overhead costs are $22 million. And we're going to keep coming back to these numbers when we start the process of activity-based costing. Okay, direct materials, direct labor, and shipping are excluded because those can be directly traced to the products or the customer orders. Okay, this is what an activity cost pool looks like. They're taking all of the different costs associated with the company and dividing them into the 4 or the 5 actually cost pools. For example, the indirect factory wages, 30% of that cost is associated with customer orders. 30% of the cost has to do with design changes, 20% with order size, and then 10% with customer relations, and 10% other. So we're going to look at these percentages for all of the overhead costs and separate them out by the cost pool. Okay, so this table right here shows all of the percentages. We're going to exchange the percentages for the number, the cost that goes there that pertains to that percentage. Okay, so just remember, because we're going to start with indirect factory wages. The customer orders are 30% of the indirect factory wage total. Okay, the indirect factory wages here you see is $6 million. Okay, so for example here, I had asked you to remember that indirect factory wages were 30%. So you see here that the total factory wages is 6 million. If you take 30% of 6 million, you get 1,800,000. So what you're doing with this table is you are taking those percentages of the total column and then filling it in. So we can see how much of the $6 million for indirect factory wages goes to customer orders, design changes, order size, and customer relations. Then we do the same thing for factory equipment depreciation. Whatever percentages were under each category, we multiply by the total of factory equipment depreciation and then put those dollar figures in there. If it had 0%, that means that activity cost pool did not have any costs under that section. If you look at customer orders, we have nothing for factory utilities and we have nothing for factory building lease. And then we also have nothing for administrative building lease. Okay, if you remember from the list of costs, the overhead costs, it was a total of $22 million. What we did is we took those $22 million and instead allocated those costs to these 5 activity cost pools. We took the percentages for each cost and cost pool and put in the dollar figure that relates to that percentage. Then we add up the total. So the total customer orders is 4,520,000. The total design changes is 3,040,000. Order size is 5,200,000. Customer relations is 3,080,000. And then other is 6,160,000 for a total of the $22 million. So we're still working with the same costs, we're just divvying them up differently. Okay, now the second thing we're going to do is we're going to compute activity rates for the cost pools. The company has determined that there are 10,000 customer orders, 4,000 design changes, 800,000 machine hours, and 2,000 customers served. We're going to take those totals and calculate what it is per customer order, per design change, per machine hour, and per customer served. The total that we had for customer orders when we allocated the costs was 4,520,000. Divide, and I'll go back really so you can see that. Okay, right here, customer orders, 4,520,000. We're going to take that 4,520,000 and then we're going to divide it by the 10,000 orders that they have. That calculates to $452 per order is the cost for customer orders. Do the same thing for design changes. order size, customer relations, and other. We still end up with the same $22 million. And now we can take this activity rate forward and then calculate what the cost is going to be based on projections for future business. So you can see that the direct materials, direct labor, and shipping costs are all cost objects allocated to the products, to the customer orders, and to the customers. So that was the first stage of the allocation. Now let's look at the second stage, which is to actually calculate how much that's going to be. Okay, we're going to start with the Sure Start battery. And with the Sure Start battery, they have no new design resources. The other battery is the only one that has design changes. We have 800,000 batteries have been ordered with 4,000 separate orders. Each Sure Start requires 36 minutes of machine time for a total of 480,000 machine hours. The long life does require new design changes, and there's 400,000 batteries are ordered with 6,000 separate orders. 4,000 custom designs are prepared, and the long life requires 48 minutes of machine time for a total of 320,000 machine hours. To calculate the cost, the overhead cost of the Sure Start battery using ABC, we are going to look at the activity cost pools that are affected by Sure Start. That is customer orders, design changes, and order size. If you remember from looking at that table, the other two did not have a percentage on it for Sure Start. They have 4,000 customer orders at a rate of $452 per order. That cost for customer orders for Sure Start is $1,808,000. Design changes are $760 per design change, but the Sure Start does not have any. The order size is 480,000 Sure Start batteries at $6.50, which is $3,120,000. That will give Sure Start a total overhead cost of $4,928,000. And we're going to go ahead and do the same thing for long life. They had 6,000 customer orders, and multiply that by the 462, 4,000 design changes, and 320,000 long life batteries for a total cost of $7,832,000. If you take the total cost of the Sure Start, the total cost of the long life, plus the costs that were not assigned because they were not associated with the products, you still get the $22 million for the total overhead cost. We're just allocating it differently than the traditional costing system. Okay, now let's just look at one of their 2,000 customers and cost out what that one customer's cost is. We're going to look at Acme Auto Parts, and they have placed a total of 12 orders. 4 orders are for long life that do require a design change, and then 8 orders for the Sure Starts. We also have listed the machine hours that are going to take 480 for the Sure Start, which requires 288 machine hours, and then the 200 long lives, which require 160 machine hours. We're going to go back and do the exact same thing for the overhead costs, but this time we're looking at a customer. They have 12 orders at $452 each. That's $54.24. I had mentioned that there were 4 design changes and that the order size was 448. And this is one customer, so the activity for customer relations is 1. Add up all those totals, that's $12,916 for the overhead cost for just this one customer, Acme Auto Parts. Now let's look at the product and customer margins. The first thing that we want to do when we calculate the product margin is to gather the information on the sales and the direct cost. Here we have the sales for Sure Starts and the sales for Long Life. That's a total of $50 million. Then we have the direct costs, which is direct materials, direct labor, and shipping. In addition to those direct costs, we're going to assign the ABC costs, which is customer orders, design changes, and order size. These are figures that were in a previous slide that we've already calculated. Looking at the product margins, the Sure Start has a product margin of little over $8 million, while the Long Life has a product margin loss of a little over $1 million. If we take those figures and put them into this calculation and then include the costs that are not assigned to products, such as customer relations and other, we come up with a net operating loss of $2 million. So this is just another way to divvy up the costs. We still have the same net operating loss, but now we have a different view of the 2 batteries and what costs go into it and how you can pick it apart to figure out what the problem is with the company, with why there's a net loss. Then when you're looking at the customer margin, you do the same thing. Looking at Acme Auto Parts again, their sales, just that one customer sales, is $29,200. The direct material was $75, direct labor was $67, and then the shipping was $17. Add in the cost assignments for ABC that we calculated before, and the customer margin is $384. And what this is saying is the company earns $384 from having this customer. Once you take what they purchase and all of the costs associated with it, they have $384 left over. Now let's look at the product margin using the traditional costing system, which would be to take the total overhead, manufacturing overhead of $14 million, and then divide it by the overhead rate, which is machine hours, and that's 800,000. You get $17.50 per machine hour. If you multiply that by how many machine hours each battery is using, we come up with the overhead cost of $14 million. Now here we're looking at the traditional costing system and the product margins using ABC. The traditional costing system overcosts the Sure Starts, which reports a lower product margin because the design changes, for example, is only with the Long Lives. But because what happens with a traditional costing system is each item is going to take on parts of all of the cost. That's what you do with the manufacturing overhead. That allocation base that you use, the plant-wide rate, is going to allocate cost to certain segments of the business that it doesn't pertain to. But that's the whole purpose of why you use ABC, is to back those back out so you can truly see what costs are associated with that one particular part of the business. So if Sure Start is undercosted, then long lives are overcosted. I'm sorry, I said that backwards. If Sure Starts are overcosted, then long lives are undercosted, because some of the cost that actually pertains to long lives is being sent over to Sure Start. Traditional costing allocates all manufacturing overhead to the products, where the ABC only assigns manufacturing overhead that is consumed by those products in that cost pool. The traditional costing disregards the selling and administrative because they see that as a period cost. ABC costing does not. They don't necessarily see as a product cost, but it needs to be taken into consideration, because when you have a product, each part of the business that product is affected by each part of the business, which includes the traditional period expenses. And that is it for Chapter 7.